Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Nancy Davis of Quadratic Capital and Chris Hempstead of Deutsche Bank. Let's kick things off with the markets. S&P 500 hovering 2% off of record highs ahead of the big Fed meeting this week. Amid the recent uncertainty on Wall Street, there's a corner of the ETF market that's outperforming right now. We like to follow those things. That's low volatility stocks and ETFs. Since the current round of tariff wars started emerging around May 1st, the two largest low volatility ETFs have seen large inflows, and they've handily outperformed the overall market. See the S&P down about 2%. So Nancy, what is it about low volatility that interests the market this year? And is there any thoughts that that might continue, that outperformance?
Yeah, no, I think it's a little bit of a misnomer because low vol stocks actually have nothing to do with volatility necessarily. They're still long equities.
Yeah.
And so we're very excited. Quadratic recently launched the first ETF to, it's called iVol, which actually owns fixed income volatility as an asset class. So we benefit from periods of market stress. To give investors
I want to
more
talk about the
choices.
iVol in a minute, but I want to get over to talk about volatility and minimum volatility. Chris, the thing that's amazing about these is you get these periods where they outperform for very short periods and then they don't. And you can buy these in very different formats. So some of these ETFs will buy the lowest volatility stocks across a whole series of sectors, while some ETFs will just buy the lowest volatility stocks, period. It doesn't matter what sector you have, and you get very intense concentration. Why is low volatility doing so well right now?
I've loved these products since the very onset. I think SPLV came out, some 6-7 years ago, and I've loved them ever since. The idea that you can keep your S&P 500 equity exposure in a core portfolio that by design is supposed to be less volatile in theoretically tumultuous markets. It wasn't too long before a whole bunch more products came to market with a similar mindset. But look, they're outperforming right now. They're heavyweight in utilities and real estate, two sectors that are playing really well into the hand of lower rates and a dovish feel. And that that also plays into, when you talk about real estate, is how do you hedge real estate? We don't really have an answer. There's never really been a good solution for that. So I'm curious, at some point later in the program to hear more about the iVol, because from what we're hearing is this is the first product of its kind that might lend itself well to hedging rates that are tied to real estate exposure.
Yeah, let me talk about that. I know you're eager to speak about your new ETF here. We've been dealing with a lot of volatility recently, obviously, and we are dealing with an inverted yield curve right now.
Yeah.
So that's a little bit of an unusual situation. How could people invest on that? How do people take advantage of that inverted yield?
Yeah, so let me explain what an inverted yield curve is, because it's really crazy town when you think about it. What it means is an investor can get paid more yield to own a 3-month T-bill, that's versus the U.S. government, than they can a 10-year bond. So you actually get more yield for a shorter duration asset. And the yield curve inverted on May 28th, and iVol is specifically designed to profit from a normalization of this crazy town in rates where you have this inverted yield curve.
So essentially, the iVol is long fixed income volatility. Obviously, that's not equity volatility. That's not the VIX. It's fixed income volatility. And primarily, you own TIPS, right? Treasury inflation protected securities. And what's the effect of this? This is you're hedging against what? The stock market, against the real estate market? What are you trying to do here?
Yeah, so we make money in periods of market stress. The same reason why are people buying all these min-vol stocks? They really want to diversify their portfolios. So we do well in periods of stress because we own volatility and benefit from an increase of market stress. But we also own TIPS, inflation-protected bonds, and that to me is a real value play right now, given how low inflation expectations are. And we actually have the options for the shape of the yield curve, so we make money when the market normalizes and when you don't have this inverted yield curve. But it's a neat product for real estate, to Chris's point, because the majority of investors have their money in homes, and home builders have been, and real estate has been the best performing sector in 2019, and a lot of that is driven by dovish Fed commentary.
So Chris, do you buy into this? Is this an effective hedge against, for example, the fact that the builders have been up on the low interest rate?
Yeah, this is the first of its kind. It's a new kind of product. Again, to what we usually talk about is how many ETFs there are out there and how much innovation there is in the space. People think there's no way to innovate in ETFs, and it's patently wrong. There's definitely ways to innovate in ETFs, build new strategies that complement others. Like the material sector as well, we haven't even talked about it, has been on a tear. And I think it follows along with the same mindset as, lower rates, we've got building, and then it's not just the builders, it's the stores that benefit as well.
Yeah, now the Fed's got a very tricky event they've got this week. They basically have to lay the groundwork for future rate cuts without actually doing a rate cut. Nobody thinks they're going to cut rates in June. I mean, maybe a small percentage of people. Most people feel there's a very good chance in July this is going to happen. So how would a product like yours be influenced by what the Fed says this week?
Yeah, so the challenge with the Fed is the rates market has actually priced in 85 basis points of cuts are priced for the next 1 year. So that's a tremendously high bar in terms of expectations because of this dovish commentary. So we can do well in two environments. One is when long-dated yields increase, which would be a normalization. And the Fed is coming out saying we want to normalize inflation expectations. We want to normalize the term premia in rates. So we think it's you got to listen to the Fed when they're speaking. This is what they're saying they want to do. So IVOL benefits from that. But if we also have rate cuts and policy rates go down in the front end, and typically that happens around a recession, we make money from owning volatility as an asset class, benefiting from market stress, and also profiting from that lower front end. So we do well in this.
You're essentially hedging against the equity market in general, but particularly things like real estate.
Equity, real estate, and also for a fixed income investor.
Okay, very interesting new product here.